So when we talk about finance, we also understand when we say finance, we are mainly talking about accounting. Okay, accounting means recording the transactions in different financial books so that you are able to account for every penny, every money, every paisa, every cent that you have earned or you have spent in doing transactions for your organization. So what are some of the transactions or what are some of the books that we maintain on the finance side? First and foremost is journals. Journals is a record of individual transactions. Individual transactions like whether you're buying, selling, everything is recorded in journals. Ledger, it's an account-wise summary of all financial transactions. Ledger, account-wise summary of all financial transactions. So journals is you're recording the individual journals. Where are you recording it? In the ledger books, books of ledger, like we call it. And the ledger also has, since every transaction is recorded, whether it is expense or whether it is an income, you will get a net figure. Account-wise, you will get a summary end of the month. Trial balance is the summary of account balances as of a date. So here you will not get individual transactions. In the trial balance, you will get the net amount against each account. What is an account? Account is the head under which an expense or income is recorded. So for example, hotel stay, training, airfare, electricity, internet, these are all accounts. So for each account, we'll have a individual journals. Journals will be clubbed together or will be recorded in ledger, which will come out with a summary. Trial balance is the summary of the account balance as of a particular date. Trading account is the summary of expenses and income for direct expenses. Trading account is direct expenses that you incur for producing a product is an trading account. Income and expense account is a statement of non-profit organizations. Income and expense, statement of non-profit organization. So in case of a non-profit organization, they don't do profit and loss. They do income and expense. That means total income that you have earned and what is expenses. For example, charitable organizations or your clubs. These are all non-profit organizations where they show a statement of income and expenses. Profit and loss is a statement for a profitable organization, an organization that is meant to generate profits. Balance sheet is the statement of financial summary of assets, liabilities, etc. of an organization. Statement of financial summary. So it shows you the health of an organization. You have the total assets on one side and total liabilities on the other side. So usually the total liabilities and assets will match up. If there are losses, that will go, that is like a, although profit is an asset, so your liability will also, if it is loss, it becomes like it goes as negative on the balance sheet. There are two main types of accounting method. One is called as a cash method of transaction Another one is accrual method of transaction. What is cash method of transaction? Cash method of transaction means entries are made, that is, a journal is made when cash is exchanged. Only when you pay the cash will it be recorded. So you buy today on credit and you pay cash tomorrow. Then entry is made in tomorrow's date. You buy today on credit, okay? And you are paying cash tomorrow. So the transaction will be made in tomorrow's date. Okay, that is cash method because that is the day you are paying the cash. Accrual method of transaction, entries are made when transaction takes place. So if you are buying today on credit, then you will record it. The entry will be made in today's date. That you have bought an item on credit today. Tomorrow, when you are paying the cash, that credit will be knocked off and cash will be recorded. So that is like a debit and a credit. Every transaction will have a debit and credit. These are the typical accounting standards that are followed across the world. The top ones, one is the International Accounting Standards, which is the IAS, International Accounting Standards. Next, IFRS, International Financial Reporting Standards. International Financial Reporting Standards. IFRS and IAS, International Accounting Standards. Now let's understand the journals a little more elaborately. Each journal has at least one debit and one credit line. Each line has an account and an amount. The total of debit and credits must match in a journal. If total debit is equal to total credit, then it is called balanced. If the total debit, total credit are not matching, then it is called unbalanced. If they don't match, then the difference amount is put against a suspense account. Suspense account is where you will record all transactions that don't match up. Journals follow double entry method of bookkeeping. Double entry means there's a debit and credit and there will be a following debit and credit which will be recorded. So then there are golden rules of accounting based on which journals are created. Journals are entered for an accounting period, and in most cases, the accounting period is monthly. In fact, in all cases, usually it's a monthly figure. So there is an accounting period. We enter transactions for the month. And if the the period needs to be open to be able to enter the transactions. If the entries don't, if the month is not open, period is not open, then the entries cannot be posted. Posted means updating the balances. Typically, these are the three types of account: personal, impersonal. Impersonal is real and nominal. What is a personal account? Accounts recording transactions relating to individuals or firms or company are known as personal accounts. Real account means accounts recording transactions relating to tangible things, things that can be touched, purchased, sold, goods, cash, building, machinery. These are all real accounts. Nominal accounts are accounts recording transactions relating to the losses, gains, expenses, incomes. For example, rent, salaries, wages, commission, interest, bad debts are classified as nominal accounts. Something that you can't touch. Okay. So three main types of account: personal account, real account, nominal account. Personal account is for individuals or firms or company. Real accounts are for tangible things. Nominal accounts are for intangible things, things like losses, gains, expenses, incomes. Okay. So this is known as the golden rule of accounting. Personal accounts, for personal account, every transaction that you're going to do, you're going to classify them as a personal account, real account, or a nominal account. If it is a personal account, then you will check how will you do the debit and the credit? Debit the receiver, credit the giver. In case of real accounts, debit what comes in, credit what goes out. In case of nominal accounts, debit expenses and losses, credit incomes and gains. So let's look at this. The business commenced with cash 70,000. So cash is like a asset, so which is a real account. Cash is coming in, and business capital. Capital is a personal account, which is the excuse me, in the name of the giver. So debit what comes in, credit what goes out, debit the receiver, credit the giver. So you will credit the giver here and debit what is coming in. Cash account debit to capital. Purchase goods on credit from Mr. B for rupees 14,000. So there are two accounts. One is goods, another one is Mr. B. Since it's goods, it's a tangible thing, it is a real account. So debit what comes in. So goods account will be debited, goods purchase account debit to Mr. Who is the giver? Mr. B. So to Mr. B. Paid wages. Wages is an expense. Cash is an asset. So cash is going out. Debit what comes in, credit what goes out. So cash will go out. Platform. Okay. See, this is how the transactions will be recorded. Anyone got any question?
এখান থেকে একটা প্ল্যাটফর্ম মাথায় শেয়ার দ্য ফোল্ডার মানে পুরো ফোল্ডারটাই শেয়ার করে দিচ্ছি। এবার দেখো বলো এটা এর নিচে গিয়ে এটা ওপেন করো।
Okay, so here what we are doing, we are recording it in this manner. This is called as the journal. This is where we record the journals. Cash account debit 20,000 to capital account, that is 20,000. Purchase account debit to cash account. Next, January 5, purchase account debit 4,000 to SS account. So here, this line that you see, that is the description, is also called as the narration. So this debit and credit amount is determined based on your golden rules. So this cash account debit to capital account, this is the date. Each date wise, you will be recording it. And this date will be in a particular accounting period. That accounting period in the system, it has to be open. If it is closed, you cannot enter a transaction. If it is open, then you can, and you will be able to post it also. Post means when you enter this transaction, the accounts don't get automatically updated. Instead, you will have a to run a posting process when the account will get debited or credited. The balance will get updated. So when it is a sales, that means the goods are going out. So debit being the amount of credit sales. Debit the receiver, credit the giver. So who is the receiver? B is the receiver. And debit what comes in, credit what goes out. What is going out? Sales. So sales account is credited, debit account, B's account is debited. Understood? Now, each account, this is what you will find in the ledger. There will be a capital account with the debit transactions and the credit transactions. This is the cash account. This is the capital account. So for every account in the ledger, there will be an entry like this. All the transactions for the month, for the period will be entered. End of the period, you will close it so that the debit and the credit tallies. So this is by cash, only one transaction happened, 20,000. On the other side, you will write two balance carried down, 20,000. And following month, that 20,000 will move to the opposite side. So it will become by balance brought forward 20,000. So which is basically this one is being coming forward. Here also the same thing will happen. Cash account, all these transactions happened. Total is 26,000. Okay. Here the total of debit and credit was 26,000. So there was a difference of 200 rupees here. So the total becomes now 26,000. So this is the balance which has been carried forward. So the difference amount 6,000, 2,000, 8,000, 600, 7,000, say 8,700, right? 8,000, 600, 7,700. Some of these numbers are not telling, but okay. So this will become then the net difference figure. So 17, 18 and 17,000. So that will make it tally to 26,000. This figure will be carried forward, balance brought forward to the following month as the difference amount, because this was excess, right? You had some excess here. So that has been brought down here.